My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Coming to you from my new home base at the New York Stock Exchange. If you want to make friends, I'm just trying to help you make some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Well, here we are. The New York Stock Exchange. It's dazzling. I love it. But let me tell you point blank, we're not changing a thing around here, except we'll have better access to some guests. Yet nothing has changed with the substance of the show. Such as it is, we just have terrific new tools that help us tell stories better for you. Consider it a more accessible, beautiful classroom. So thanks to all of the myriad people who made it work. Thanks to Mark Hoffman. He's the chairman of CNBC. Thanks to Regina Gilgan, who's our executive producer. Thanks to Cliff Mason. He's our head writer and only writer who's been with us since the beginning. Now let's talk stocks. Or actually more. Today we were looking good until we heard Apple slowing the pace of its hiring, which caused a wholesale rush to the exits. The Dow sinking 216 points, the S&P slipping 0.84%, NASDAQ losing 0.81%. Sell. This kind of hiring thing that Apple's doing is always viewed negatively in the tech world, even though Wall Street's desperate to see less hiring. Why? Because it means the Fed's winning its fight against inflation, and that's what this market's all about. Of course, part of this pullback is because we had huge gains on Friday, and we were due for some weakness. In this environment, it's always going to be fragile on the upside and easy on the downside, because the bears, they got an upper hand. Just keep in mind, you should never buy this market when it's up. That's a fool's game. I want you to wait for weakness like we had today before you ever pull the trigger. If you're thinking about buying something that's about to report, why not wait until you hear what they have to say? Just look at what happened to the formerly strong IBM, one of the best performing stocks in the Dow after the close. It got completely slammed. Sell. If you bought it ahead of the quarter, you rolled the dice in a casino that's not friendly to blind dice rolling. And make no mistake, before the Apple chatter, today was good. Hey, make that great. And then suddenly ugly. All the way to the close. This morning, Goldman Sachs reported a great number that came out of nowhere, frankly. I was blown away. All divisions doing well, especially trading. Goldman's a cheap stock with a great yield, and I think it's a buy. More on that later. This is just the latest bank to report a much better than expected quarter, following on the heels of Citi. Did you see that quarter? It was great. Wells Fargo, yes, thank you, Charlie Sharp, for doing a good job. And Morgan Stanley, James Gorman, always doing a good job. The banks now represent a tremendous leadership group in this market. Of course, Bank of America also reported a good set of numbers. This was its usual consistent quarter, but it could only muster a yawn. I think the internals were terrific. And I got to tell you, the leverage to the Fed raising rates is superb. We're talking about like $1 billion per 0.75 point. Stock deserved more love than it got today. But with all that good and somewhat, when it comes to Apple, bad news out of the way, let's go to our game plan for the rest of the week. And this is what I'm talking about with this new set, how great this is. You know what? I even look thinner. Well, no, they have me wearing some sort of girdle. It makes me look thinner. I'll take it off as soon as the show's over. All right, well, first, tomorrow morning, we're going to see a new transition quarter from Johnson & Johnson. This company is breaking itself up into a slower growth consumer products business and a higher growth pharma and medical device business. I expect good numbers even in the interim. Well, this drug stock has fallen behind its cohort. And by the way, the whole cohort just got completely annihilated today. I bet it can play catch up. That's one reason we own it for the charitable trust, which, of course, you can follow along by joining the CNBC Investing Club. Hey, speaking of the Investing Club, we also hear from Halliburton. Yes, the oil service titan. Halliburton's earnings are soaring, yet its stock has been crushed. It's down 8 straight points. I think it's time to reassess this one and recognize that the earnings could be huge for Halliburton, not tomorrow, but for years to come. Also on Tuesday, there's Lockheed Martin. Now, this should be the moment in their sun, right? Why? Because the West is rearming. But the stock peaked 70 points ago. Hey, maybe it can reignite? Then again, there were some very big sellers all day. Did they know something? We'll find out soon enough. Oh, after the close, we hear from a fallen star, Netflix. The last quarter was, frankly, I struggled for a word. How about incoherent? I expect a much more thoughtful call with commentary about their new deal with Microsoft to offer an ad-supported track. For the longest time, Netflix told us there was still plenty of growth left in streaming. Now the field is crowded with competition, and the growth seems to be evaporating. Call me not optimistic. Now, Wednesday, we get the results, rim shot, from Abbott Labs. Now, this is one of the most erratic companies because of its volatile COVID testing business. Now, that's going to run out someday, but in the interim, it's terrific. How many times did you test this weekend? I like to test like every 3 or 4 hours these days. That said, Wall Street doesn't like a business. That's almost not an exaggeration. Wall Street is not like a business that might not be around in 12 months, and that is probably what's going to happen. After the close, we have the most important quarter of the week, and obviously that's Tesla. Now, the estimates are all over the place. There are a huge number of sell ratings and as many buy ratings. Musk is still expanding like mad, and he jokes about how funny it is to burn money, put it in a chimney, a furnace. Still, if Tesla can exceed even the lowest estimates, the stock goes much higher. Thursday, big. We start with ATT, which usually puts up decent numbers, but no better than that, and I find is boring, and I don't want you to own it. Then we have 2 good reads from the Fed's war against inflation. We got Freeport McMoran, that's the giant copper miner, and Dow, the chemical company. Plastics and copper are directly tied to economic growth, so these companies can tell us a great deal about the situation. Now, the market has turned against a series of industries, with the latest being the rails and the home builders. My favorite railroad, Union Pacific, reports Thursday morning, and I'm very worried about a deceleration in their business. Hey, same goes for D.R. Horton, the giant home builder. Listen on that call for cancellations, and that's what I'm most worried about. Home deals aren't closing. Home confidence down huge. Soaring mortgage rates tend to do that. After the close, we have the one stock that started this whole social media meltdown, Snap. This thing got clubbed after the last quarter, and it's been down in the dumps ever since. Also at the close, Mattel reports, and I like this one. They've consistently beaten the numbers. But then there's the opposite, Boston Beer, the parent of Sam Adams. I expect a weak quarter and declining hard seltzer numbers. They've done that now for the last, I don't know how many quarters. I would much rather own STZ, Constellation, as Corona, Modelo, and Pacifico are simply just a better set of brands. We own Constellation with the Child Trust, and we will compare quarters when we review Boston Beer the next day. Okay, here we go. Friday's incredibly consequential. It usually isn't during the summer. That's wrong this time. It starts with American Express, which is just downgraded, but I think will do quite well because of all the small business and consumer spending, not to mention travel to Europe because of that strong dollar. I don't know where all the negatives are coming from. We also have Verizon in the morning. Now, the last quarter was widely panned, and I don't expect a repeat of it. If you want wireless still with some growth, that's T-Mobile. Verizon for value and AT&T for nothing. Schlumberger reports in the morning, too, and this oil service giant should report a very good number. Like Halliburton, you don't want to ever put your back to that. I'm learning all this stuff. It's my 18th year in this stuff. I'm really starting to get it. Okay, Halliburton is domestic. Schlumberger is international. We call it SLOB. That's what we do when we're downtown here where we are. Represents the best international service provider. Halliburton's strong domestically. Finally, there's lowly worm Twitter. If Twitter still reports on Friday, I wonder how much time they will spend talking about the lawsuit against their putative acquirer, Elon Musk. Hey, last week, Musk's lawyers answered the complaint Twitter tried to make for him. You remember, Twitter's trying to get him to buy the company. Want him to fulfill his end of the contract. I found his whole defense pretty flimsy. I continue to believe Musk will be forced to either buy Twitter or give them so much money that he might as well buy Twitter. Now, we have an amazing show for you tonight, discussing the biggest winner since we started the show 17 years ago. And then David Solomon, he's the CEO of Goldman Sachs. And finally, one of my favorite people in the world, billionaire, philanthropist, and in many ways, someone who represents the best traditions of this hallowed ground, Ken Langone. I've known Ken for a long time, and his book, by the way, I Love Capitalism, is the standard gateway into business. You should read it. Bottom line, stay tuned. Hey, let's start with someone from my home state of Pennsylvania. Let's start with Ron in Pennsylvania. Ron.
Hi, Jim. A big Bucks County booyah from New Hope.
Well, you know that's where I'm from. New Hope. Ah, hey, Karen's from there. Terrific. What's going on?
Hey, I'm an investing club member, and I love the new clubhouse on the New York Stock Exchange floor.
Oh, thank you. Thank you so much.
Hey, I'm calling about a company that I'm not only a stockholder of, but a recent customer and know their product all too well. Earlier this year, I was diagnosed with prostate cancer and scheduled for a radical prostatectomy utilizing the Da Vinci robotic system. The surgery and recovery went extremely well, and I'm now in complete remission. Unfortunately, I can't say the same for the stock.
Right. All right, well, let's talk about Intuitive Surgical. I mean, this was once a great growth stock. It's now part of what I regard as being one of the hardest cohorts there is, which is the medical device cohort. It reports this week. I expect a good quarter, but you know what? The last quarter was good, and no one cared. So my take is it's a decent long-term story. It sells at 40 times earnings. Nobody likes 40 times earnings. New set, same mission. We've got a lot of stuff going on this week. We've checked it out. But how about today? Mad Money Tonight. We're coming at you, well, obviously, from our new home. Does it look different? I think it looks different. And we're talking to billionaire Ken Langone to get his take on everything going on in the market and in life. Then when we started this show 17 years ago, the market looked a lot different than it does now. So we're tracking the best performers in the S&P 500 since Mad Money's inception. See who came out on top and how much money it could have made. And Goldman Sachs reported a strong set of numbers for the morning for the second quarter. I'm going to learn more about what drove the strength with the company's CEO, and I think you'll find it darn enlightening. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.